Are you curious if checking your bank account every day or week is the right cash strategy for you? This video is for you. My name is Natalie Cook, and I am the owner of Finance Fight Club. I like to talk about finance, and today I want to talk about working capital and cash flow strategies because I've had a couple interesting conversations in the last month, and I've worked through a very complex working capital strategy with a client, and it just made me think, on a prospect call, they were like, well, should we just go off of what's in our bank account? And it's like, well, no, that doesn't give you your whole picture of cash. And so today I kind of want to break down a little bit about working capital, a little bit about cash reserves, and a little bit about how you might want to think about your overall cash strategy slightly different in your business. One thing I want to say before I dive into that is that as I become a business owner and a fractional CFO, and I have probably reviewed well over 100 profit and loss and balance sheets in the last few years, if not more. One theme that I think is very consistent is that term debt gets you into a lot of trouble, and it is very hard to get out of term debt. So taking on term debt, what I mean is taking on a $500,000 loan for your business and then having to pay it back over time causes lots of issues. I have rarely seen it go well. Now, it's not that it can't go well, or it's not that it can't get paid off. I have seen those things. But for the most part, term debt for a business feels not great. And I'm kind of against it. I'm not like, I wouldn't, if a client wanted to do it, we can do it. And we've done it. We just are closing an SBA loan today. But for the most part, it's a really tricky thing and it's hard to get out of, and you have to pay it off. A working line of credit is a little bit different. So I'm not going to talk fully about debt today, but that does go into our cash strategy. And I wanted to give the perspective of that. I've just built up more of a perspective that you can run a very healthy business with no debt, and that is better for everybody. And yes, you could say in the large scheme of finance that loses your ability to leverage something. I think peace of mind is better than leverage. So that's what I'm here to tell you. And that's my perspective and my point of view and my bias as we talk about cash flow strategy and working capital on what I believe and what I've reviewed. This is my starting place. So before we dive in, let's do a little bit of definition. So working capital, you can do backwards looking working capital and you can do forward looking projected working capital. This is the amount of money that you need in your business over a period of time to get you from when you're going to receive and when you're going to pay. So this is, hey, we're going to have $500,000 of payroll every month. We need to hold that in the bank account, or every 2 weeks, we need $250,000 just to maintain payroll. It can, and that is getting you that gap between when you have to pay things and when you're going to receive new revenue. Everybody's working capital is very different. It's also highly variable. So there's a lot of variables that go into it, and you change one of them and your working capital can be vastly different. And what I like to err on the side of is that you likely, even if you have 30-day terms to get your receivables, you're still going to lose some of that money, right? Some of that is going to take 60 to 90 days to recoup. If you have AP, you may not pay that all exactly on day 15 or day 1 or day 45. So it's not a cut and dry number. You really have to know all of those receivables and be able to do some sort of weighted average to get that real information. You also might need to manage working capital by different lines of revenue. What revenue and costs need to come in and go out. It's very nuanced. If you're looking at working capital on your balance sheet, you're going to take your current assets minus your current liabilities, and that's going to give you a number of what your historical working capital has been. Where is it? Where does it meet? And then when you're forecasting your working capital, you're going to do a very different formula. I actually have a spreadsheet on it. I will link it down in the comments you can utilize this to look at your working capital. But what you're going to use is your sales per day, which is your revenue. Let's say you make $100,000 a month. It's that divided by 30. So what does that get you per day? How long does it take you to receive cash? So that's your accounts receivable number. Is it 30 days? Is it 0? Is it 45? Is it 90? It's going to take into account your inventory. I'm not going to talk about inventory right now, but that's a big part of working capital. And then it's going to take into account your payable terms. So if you, realistically, I kind of put everybody on a 15-day because of payroll is about every 2 weeks. That's not 100% accurate, but that's just kind of my starting point. But let's say you have 45-day terms, you can put that in. If you are paying everything to your vendors the day that they do the work, then you're putting 0. That's kind of your margin there. And then that's going to give you a number. And then every time you change one of those variables, either your revenue goes up or your terms change, you're going to see a different working capital requirement. And that's your working capital forecast. Now, to go one step further, you are also going to take your full forecast. So let's say you have a 24-month forecast, you're going to divide that into sales per day, and then you're going to do that for each month. And you're going to notice that it's going to change every month. So let's say 1 month you are low in revenue, and then 1 month you're much higher in revenue. You're going to see that fluctuation in working capital. That's just one number. So what do you do with working capital? Working capital is hey, at the end of month, we have to keep maintaining this number so that we can get through the next month. So let's say your working capital is $1 million at the end of the month. If you don't have $1 million, you need to look through and see what you can push off next month to just alleviate your working capital. Or you're looking at insolvency. Not always the case. Sometimes there's a lot of wiggle room in there, and there's a lot of changes week by week, right? You can push some things, you can not push some things, you can negotiate. So there is a path forward from that. The second piece I want to talk about is cash strategy and cash reserves. Cash reserves are outside of your working capital. Working capital is just, I need to maintain these balances or my business does not function, right? Cash reserves, on the other hand, are your emergency fund, your tax savings, your future investments in the business. And I have a whole video on, I believe I have a whole video on the cash management triangle. That is my own kind of framework that I use to look at cash. Those are separate from working capital requirements. So if you need $1 million to get through each month, you need additional reserves to build up the cash reserves in your business. So you need taxes. That's a big one. You don't use your taxes as working capital because you still are going to have to pay those taxes. You need to reserve those separately in your business somewhere else, either on a spreadsheet. You need to know what those taxes are, or you need to put them in a separate bank account. You also need an emergency fund. Typically, the bare minimum, 3 months of payroll or 3 months of the expenses that you can't wind down in 30 days. That's the minimum. Ideally, 6 months of operating expenses in a cash reserve, and then you don't need debt financing. You can be your own bank. And then on top of that, you also need, what are your future investments? Are you going to need new equipment? So should you start saving for new equipment? Are you going to hire? Should you start saving for hiring? What does that look like? That's a separate bucket. Now, if you have working capital and your cash reserves at your taxes, your emergency, and your investments, debt financing is not even a thing that you need. Now, that's not to say that you shouldn't go after it. It costs money to borrow money. It costs money to have a line of credit. It costs money to have term debt. It's not to say that you can't have a great business and have those things, but this alleviates any requirement for debt if you are really following that strategy. So while this video kind of started as a breakdown of working capital and cash strategy, it kind of ended as a, hey, kind of here's a PSA for why you maybe don't need debt in your business, or here's a path to it. If you are interested in talking more about cash strategy or working capital, find me in the links below and I'm happy to chat. Thanks for being here today. I am Natalie Cook with Finance Fight Club. I will see you next time.